Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial, and there is a lot of news out there to talk about today, but I'm not doing this at my regular time. Sorry about that. I was a little bit busy doing a few other things. Did put out a video a little bit earlier on the FTX lawsuit. There are like 8 YouTubers out there that are being sued for promoting FTX. We can talk about that if you want, but did want to talk a little bit generally about markets today. The S&P 500 is back up close to the 4,000 level. I stated in earlier live streams that it was likely to go down to about 3,800. It got close to that. I still think that we probably test the 3,800 level again before the end of June, and that is probably the earliest time that we're actually going to see the market kind of start to take off again, where we go risk on. One thing I did want to talk about today, though, is definitely the possibility of the Federal Reserve raising interest rates at the next meeting. I honestly think that the possibility of a 25 basis point rise is still very much on the table, but that the probability that there is no interest rate rise, that there's a pause, is pretty good in there too. And let's talk about why that is. Now, you can barely see this on my screen down here, but we're looking at global yields in terms of bonds. Bonds here in the United States are significantly higher than those in the EU right now, which means that there's going to be tons of money pouring in from foreign investment. It's going to artificially sort of support prices here in the US. And this is even after a surprise half a point rise in interest rates by the European Central Bank. And I think that's one of the big reasons that the Fed may decide to pause interest rates, because there's such a difference between our interest rates and interest rates all over the world right now. We're a lot higher, especially on a 1 year mark. Yields are basically 1.5 to 2 points higher at this point. The other thing, of course, is the banking crisis. If the Federal Reserve raises interest rates by another quarter point, there's going to be an immediate price difference reflected in the bond market, which means we're going to see bonds decline even more in price, which means that those unrealized losses on the balance sheets of banks are going to become even greater, which may force some banks into more trouble. Now, the Federal Reserve and the FDIC has set this precedent at this point that at least depositors are going to be protected in this case, and they've made private sector buyouts. They've helped arrange private sector buyouts of all of the banks so far. And let me tell you, these banks that are performing the buyouts, they are going to make out like bandits. The other thing that's happened is that bondholders of these banks are pretty much getting screwed. This is kind of weird. What happened with Credit Suisse is a certain tranche of bonds, about 17 billion. They're called COCOs. There's a special arrangement with a bond that can be converted. It's a convertible bond that can be converted under certain conditions. All those bondholders got screwed. The shareholders end up getting some UBS shares, but I think at about 50% of the value of the shares on the day that that offer was made, and which means there was a subsequent crash in the price there. But the big deal is that's kind of out of order. The it's generally the shareholders that get screwed first, then the bondholders get screwed after that. So this kind of turns the financial world up on its end a little bit here. So this is something that is on. Fred C says, should we expect inflation in the coming months if rates pause? So I think the answer to that would be very, very unclear, Fred. It is, the generalized answer that you get from people that don't really look at inflation very much is it's all related to government printing. It's certainly not. It's a commodity shock, like energy shock, has been one of the major causes of inflation for the last 6 and 7 inflation events, and it's almost always been supply constraint related to some degree. It's certainly been exacerbated by massive printing of money by governments, and this isn't going to help either. But if we see a corresponding decrease in employment and therefore a decrease in demand for products overall, we may not see higher inflation in the coming months. That is definitely a possibility. But last year when people were already calling for stagflation this, stagflation that, I was saying, hey, it's a little bit too early to talk about that. If this continues much longer, that is something that definitely needs to be included in the conversation. But let's be honest, we've only been going through this inflationary period since about the end of 2021. And we are now about 1.5 years into this at this point. So this is what I am really concerned with, though, is hold on a second. the Fed will have to raise rates. Otherwise, people will think that they're not raising rates because of a banking crisis that they say doesn't exist. Possibly and possibly not. Like I said, the two mandates of every federal bank or of every national bank are going to be, number one is going to be asset price stability, and that is what the Federal Reserve really wants to do, is preserve asset price stability. But the Federal Reserve has decided to sacrifice asset prices in order to decrease employment in this case. So you may be correct that they may continue to raise interest rates. I think that half a point is definitely off the table. A quarter point is still very much possible, but I think the pause in interest rates may be on the table as well, and it's certainly greater than it was earlier this weekend. I think market calming and the fact the market was up a little bit today doesn't mean a thing. I think it'll probably be back down again tomorrow, as it is clear that this is going to be a rolling mini crisis. I still don't expect there to be that many actual collapses this year. I think in terms of the US, there will probably be less than 10 banks that collapse, maybe even less than 5. And that really has to do with and of course, I don't know every bank out there, but I'm trying to think of other banks out there that have a risk profile, kind of like Silicon Valley Bank did, kind of like Signature Bank did, and like First Republic. And First Republic really shouldn't be included in that group. It is more sort of geographically based. They simply do a lot of business in Silicon Valley. I don't know if they're being unfairly painted with this brush, but let me tell you one thing though. Insider buying of banks is really, really high right now. There are a lot of insiders buying at larger, more established, older, more conservative, stodgy banks right now. These guys are buying their own shares like crazy. There are Form 4s being filed all day long today, and you'll probably see more of that going forward in the weeks ahead. Banks like Wells Fargo, JP Morgan, Bank of America, Citigroup, Goldman Sachs, these guys look great, and they're going to be able to buy assets at fire sale prices. This is going to be great for them in the long run, and it really is going to hurt some of these banks that had specialized business. The next big shoe to drop is going to be commercial real estate for smaller regional banks. There is a reckoning coming in commercial real estate, especially banks that are heavily in office in office buildings. So it's almost impossible to get out of a commercial lease. Elon Musk is about to find this out. But when those leases start to come due, and some of these people have really long-term leases, some of them don't. Right now, we're seeing that office occupancy based on, and there was actually a company that goes out there and figures out what office occupancy is. They're stating that it is about 50% of what it was in 2019. A lot of companies are going to figure out that they need half the office spaces they did before 2019. They are stuck in their commercial leases right now, and they're going to be walking away from those or renegotiating them as they come up for renewal. So we can see that there's going to be a higher degree of non-performing assets in commercial real estate relatively soon, particularly those that are heavily invested in office buildings. So we're looking at giant downtown areas and things like that. That's the reckoning that's coming next. And that's where I would think if there is going to be another wave of bank failures, it's going to be in those mid-sized regional banks or smaller regional banks that are highly concentrated in commercial real estate. And that's what I'm concerned with. And that's where I think that if we have another emergency like this and those smaller banks end up getting infected by this, this is where we'll go over that 10 bank limit that I'm saying would possibly happen this year. There isn't anyone else on the horizon right now that is absolutely looking like they're in danger. And I do have to say that Credit Suisse, guys, is another special case. I don't think that a lot of folks here have followed the sort of trials and tribulations of Credit Suisse, but I have been involved in dozens of, not court cases, but dozens of times I've been involved with incidents that were investigated involving Credit Suisse. They are a bank that has been scandal prone for 60, 70 years, maybe even longer than that. You know, beginning in the year 2000, they had a market cap of roughly $70 billion. They ended up being sold for about $3 billion or just this last weekend. This is a bank that's been going downhill for 23 years. And I don't think there really was a way to stop this going forward. I think at some point they were going to become a concern that was no longer going to be able to continue, and they were going to end up being acquired anyway. This just sort of accelerated it. So that is kind of the exciting or less than exciting news on banking today. Some of the other things that I'm looking at as well are banking stocks. So even in cases of banking stocks right now, if you guys, and remember, because of the FTX lawsuit right now, I gotta state once again that nothing I talk about here is an endorsement to buy, sell, or hold any security. You got to do your own research, come to your own decisions. Don't listen to some guy off of the internet in order to place your bets. So we see here, and this is okay. Maybe it's a good idea to let these banks fail. So the banks are failing, but how they fail is important. I think it's important for the depositors in the bank to be made whole based on how much they deposit, right? I think if you put $10 million in the bank and you run a business where maybe you do $10 million in cash per month, you should be that should be guaranteed. But the bondholders and the stockholders are the folks that are buying ownership or loanership in the bank in return for increasing share price or passive income from the bonds. You are taking an ownership stake in the bank and therefore making money off of the risk that the bank is taking. The depositors, ostensibly, if you have less than $250,000, you should be risk free for you. The problem is that you get into companies that are dealing in 30, 40, $50 million a month. There aren't 40 or 50 banks out there who can do business with them. And there isn't a way to do that business efficiently anymore. I was just looking at these little micro transactions for another business from Twilio or something like that. And it was like $10 here on a daily basis, but like 30 or 40 different transactions. Multiply that by like the 2 million customers that they have, and there's just no way that they can spread that out across 40 or 50 different banks. So the M2 money supply is going up. I would guess this is a response to banking issues and the opposite of qualitative tightening. Well, the M2 money supply has absolutely cratered in the last 6 months. And there were a number of voices out there. I was not one of them, but a number of voices out there that were concerned with deflation, a deflationary cycle. I don't have all of the answers to that, but the M2 money supply has really only gone up for the last week or so. I did take a brief look at just a chart this morning, so I don't know where the numbers are. But yeah, I would say that keep an eye on longer term trends and not necessarily, on a weekly basis. The main thing that the Federal Reserve has done is to open up credit lines to some of these larger banks, and to banks like First Republic as well. But they aren't engaged in the same sort of qualitative easing that they were doing by buying government securities or anything like that. They're still doing balance sheet roll off. Interest rates are still a lot higher. Credit is about to get a lot tighter though, and this is one of the things that's being reflected in bond spreads right now. Spreads between B or BAA rated, which is like the first level of junk bonds, just below investment grade bonds, and the 10-year Treasury are starting to increase pretty rapidly, which means that bond traders are really starting to price in the risk of default. Now, it hasn't really reached fear levels at this point. It's still very much in the middle of neutral, but it's a lot higher than it's been in the last decade or so. If you take out a few spikes surrounding COVID, it hasn't really been that high in a very, very long time, which suggests to me that risk is increasing in markets. People are pricing it in. They are really concerned about the future, where even a month ago, there wasn't any real concern about the claims or about the credit quality of investment grade banks or investment grade companies that are out there. The demand to be paid for the risk that you're taking is raising interest rates all on its own, and the bond market is actually doing the job of the Federal Reserve right now. Interest rates are rising on corporate issues, even though the Fed is not intervening, and that's another reason why the Federal Reserve may decide not to raise interest rates at this next meeting. So I think there's about 50-50 that we have a 25 basis point rise, 50-50 or 50% chance that we have no interest rate rise. I think there's now a 0% chance that we see a half a point interest rate rise, like some folks were talking about here, because the numbers on inflation weren't as encouraging as we expected. Now, look, The Federal Reserve, when they make these projections, are always dealing with trailing data. Policy is going to trail that data by a few months. So what is happening now is not necessarily reflected in Fed decisions, and it really shouldn't be. They need to be looking at trailing data. But the roadmap that they set out for us just a month and a half, 2 months ago, I think that is changing at this point. And that's one of the things that the Fed has been really good about telling us exactly what they're going to do well in advance of when they do it. And you see betting markets swirl around what they think the Fed is going to do, but the Fed has pretty much signaled exactly what they're going to do now for over a year. I think that is in question now. I think that the reaction, well, I'm not going to say that you can ever judge what the market is going to do on the day that the day the Fed makes the decision. That those reactions are sometimes counterintuitive. But today is the first time in over a year where I'm going to say that we don't have a real clear signal on what the Federal Reserve will do. I think 50% chance there's a 25 basis point rise, 50% chance there's no raise in interest rates at all, and a larger than 25 basis point rise is probably off the table at this point. Um, Asset prices, though, still look decent compared to this time last year. Every asset except energy was underwater. This year, we have a couple of asset classes that are still above water. You're still making a little bit of money here. We'll see what that looks like by the end of June 30th. I expect to see a flight to quality here in the next couple of months, where we are going to see people moving into longer term, short term government securities, longer term corporate bonds of really high quality, and people buying S&P 500 stocks, good quality stocks, stocks that have paid a dividend, who have betas of close to one or under one if they can, and companies that are just very, very established. A lot of companies from consumer staples and are probably going to be included in that. Healthcare, and believe it or not, financials. I think that financials probably make a pretty good recovery, largely because most of the companies on the financial indexes aren't some of these smaller regional banks with concentrated portfolios. So some things here to be positive about, definitely. But guys, the trouble is not over. We're going to see the market struggle for the next couple of months. And if you're a first-time investor kind of going through this, all I got to say is get used to it. Markets go through this all the time where there's tons of uncertainty. A lot of times you make the most amount of money when the market is bad by doing nothing. If you have extra money, now might be the time to snap up some good deals in a lot of places. If you've never thought about fixed income before in your entire life, the next year or so may be a really good opportunity for you to start that bond portfolio that you've never really paid attention to. And it's a great way to smooth out the ups and downs in your portfolio. This is not something that a lot of YouTubers talk about. People want to talk about the exciting stuff that is stocks, but look at the returns of actual investors over a 10, 20, 30-year period, and you will find out that folks that have a mix of stocks and bonds tend to do better in the long term, particularly if they are frequent traders. Now, if you're 100% stocks and you don't do a ton of trading, like maybe once or twice a year you do trading, I'm serious about that, then you will tend to outperform folks that are far more active than you are, and folks that are in and out of stocks. It's just one of those things that happens. Tell 666-999 frequent watcher, thank you very much for showing up today. Hey, I'm happy to field any questions you guys have today. I'm a little bit behind in terms of when I got started today. I was doing a few other things, but did want to talk about a little bit about how was up 382. Was up, and the S 500 was up 39.51. I don't expect it to stay at 39.51 for very long. Keeping a close eye on, just because I and Bear AI Holdings, of course, down today with very little in the way of explanation. It is definitely way too high in terms of it basically it caught the AI wave and everyone started buying it. Tesla today washed again. This is a stock that I do own a bunch of shares in. I am way down on this stock with you guys. Hold for a very, very long term now. But any questions you guys might have, I'm willing to talk about today. Something I haven't talked about in a while is EV news regarding Chinese EVs. And this website right here is autonews.gasgoo.com. And there's a new energy section in there. It used to be filled up with nothing but information on NIO and Xpeng and a few other companies. This is no longer the case. Their top stories are from Zeekr, which is a brand of Geely Auto Group, which they are reporting that their registrations are reaching highs. This is a company that already produces about 1.7 million vehicles. BYD is expanding their passenger vehicle models. They're making a debut in Uzbekistan and a couple of other places. Xpeng sees 2022 revenues from vehicle sales jump 23% year on year, which is great, but they basically didn't meet expectations again. And here we go. We're looking at also a commitment to where was this that I saw? There's another company out there that is starting their own battery swap program as well. Let me see here. I'm trying to figure out if buying in a Western Alliance bank at 28 was a good idea. I'll let it ride out. Clearly, the Fed can't raise interest rates anymore. They've seen it happening. I would say that it's not a chance of anything being clear. I would say, though, that raising interest rates by another quarter point is going to cause bond prices to crater again for corporate bonds and yields to rise even more and borrowing to become more expensive and for unrealized losses to grow on balance sheets. So I think that there's at least a 50% shot that we don't have an interest rate rise at all in this case. Let me see here. U.S. intelligence shows that China's President Xi Jinping has instructed this country's military to be ready by 2027 to invade Taiwan. I wouldn't read too much into that, and I'll tell you why. I've read basically the United States game plans for everything, and we probably have a plan to invade every country on the planet. And there may not be a reason to ever invade. I bet we have a plan to invade Iceland or something like that because it's just strategically on the way to other things. I bet we have a plan to invade all of our neighbors and take over their military bases at some point. I don't believe that I would take that entirely too seriously. I think that the threat of invasion is pretty low because the United States has made it pretty clear that we would bomb Taiwan's chip factories rather than allow them to fall into Chinese hands, meaning that you can try to take Taiwan all that you want, but all of the talent is moving here and the factories that you do take over are going to be worthless. And that's really the only reason to invade Taiwan. It would be to take over their chip industry. They don't have really any other resources that are out there. And I realize there's political angles, historical angles looking at that as well. But they're not dumb, and I think that a lot of this is done for show. There's always going to be a plan to invade Taiwan, just like the United States probably has, plans to invade, Tuvalu or something like that. I don't know. I'm not saying we ever would. I'm saying there is a plan out there on paper, and one of these days someone's going to drag it out and say the United States planned to do this. We probably really didn't. So yeah. Will President Xi tell Putin to stop the war? That is a key question. Without China-Russian dietary. No, he's not going to tell Putin to stop the war. So Putin or Russia has always been a threat to China's interest, and that friendship was always going to be a rather cold one. The time when they could have really been allies was when they were both ostensibly communist nations, but they weren't. They weren't communist nations in the way that I read about communism and think that communist nations are supposed to look like. But they didn't get along at all, and we exploited the schism in relationships beginning in the 1970s and split them off with most favored nation status, and then basically tore them out of that orbit starting in the 1980s with trade agreements with China, which, by the way, in the beginning of those trade agreements, China was the one telling the United States that we had to buy more products from them and that they were buying a lot more products from us. And now the opposite is true. So I don't think that their partnership without limits actually exists in reality. I think this was a gamble with very little downside that China took. Said, hey, if Russia can change the world order, let's make it happen. But it's not going to happen to a degree. And I think that the danger of Russia falling apart if they don't win in Ukraine is a lot greater than it was a year ago. I think they had an opportunity last summer to basically act like a pigeon and pigeon playing chess, which is basically knock over all the chess pieces, crap on the board, and then go home. And they could have claimed victory. I think that those days are done. They stayed a little bit too long. Yeah. So tell 66999. Thank you so much for the super sticker. Yeah. By 2027, America should have onshored most chip manufacturing and other interests. So there's an issue with onshoring most chip manufacturing. These factories are going to take years to build. Excuse me. These factories are going to take years to build, and we have to import a lot of talent to do that as well. And I do think that is probably going to happen, but it's not going to happen without massive tax incentives, probably without massive public investment in these industries. I would like to see that massive public investment in these industries done a little bit differently, though. Like, I don't necessarily have an issue with basically a sovereign wealth fund being created to which everyone in the United States is going to be a shareholder of, which would go to fund basically fund government activities. I wouldn't have a problem with the United States having like a sovereign wealth fund like that to promote the development of industries. I don't think it's going to be enough to tell Taiwan, hey, move all of your chip manufacturing here to the United States. It's probably cheaper. It's probably less risky. It's definitely not going to be cheaper. Labor expenses and regulation expenses are going to be a lot higher here. So Michael says, agreed. Western countries, we started to realize reliance on other countries for key parts. It's entirely likely that we become more dependent on each other within our own sphere. So I think that's probably what's going to happen. But actually, there's somebody ringing the doorbell at my house, which never happens. I will continue to ignore that for a bit. But actually, we're coming up on about a half an hour. But yeah, war in Ukraine, I am following that on a daily basis. There hasn't been a lot of news about that recently that's going to impact us economically. What I am looking at happening here in the future is what is going to happen to wheat prices this year. We got really lucky last year with basically bumper crops worldwide in terms of grain crops. And we saw a lot of different ways in small amounts to replace what was being produced by Ukraine. I'm not sure that happens this year. I'm not sure that the grain deal that was worked out with Ukraine, Russia, and Turkey last year holds either. So those are definitely some of the concerns that I have. Okay, guys. I just wanted to get on really quickly today because I was delayed, and I promised to give you guys a little live stream every Monday and every Thursday. Check out the video that I did on the FTX lawsuit. It's just a very quick rundown on what I think is going on. And the YouTuber that is making he's basically doing the dumbest thing you could do when you're sued with something like this. He's talking about it. I think he really needs better legal advice. And if you go back and look at his tweets and his videos, he's basically admitted everything that he's being sued for. But I will say one thing. This lawsuit is going to be far more complex, going to be more expensive, and it's going to take a lot longer than everyone thinks. And most people are probably going to settle out of court, and there's going to be non-disclosure agreements, and you're not going to know in the end what actually happened, and that's going to be kind of disappointing. And some parts of the lawsuit are probably going to get dismissed as well, because there is a degree of caveat emptor when it comes to buying cryptocurrency. It is not a security, or in some districts, it's considered an unregistered security, but there isn't. The regulations around that aren't very clear. But the regulations around promoting financial products, even if they aren't securities or they're unregistered securities or securities registered at the state level, those are very, very different. And some of these guys may be in trouble. But I am curious to find out who actually took money from FTX and who did not. That is something I really would like to find out. My bet is that Tom Nash did not actually take money from FTX. He may have. I definitely haven't watched all those videos, and I don't watch a lot of what other financial YouTubers do. But my bet would not be it, because the videos I have watched from him, I do tend to like. I don't always agree with the guy, but I do tend to like his videos. He does produce a lot of content that I have enjoyed in the past, even though I don't watch a lot of his stuff. Anyway, guys, thank you very much. I will see you on Thursday, and I will probably have another video out on Wednesday. I'll see you guys later. Bye.